Hello, I'm Mike Marchlick.
And I'm Mark Swirsky.
And welcome to another edition of Insights from Great American Group.
So, Michael, I understand we have Jay Goldinger coming in next.
We do.
I've met Jay and spent some time with him. He's a sharp, brilliant man, economist and an interest rate guru, and I know you use him a lot for a lot of personal and business use. What are we looking at for Jay? What do we expect to hear from him?
Jay's going to come in and talk to us about the global economy, domestic economy, and what we can expect in the next few months, and how it relates to our viewers' business.
Great.
Now joining us is Jay Goldinger, an advisor, an economic consultant. Welcome, Jay.
Thank you.
If anything, what we've learned from you over the years is that we shouldn't always believe exactly what we read or hear about in the press. So, from your perspective, what's going on with the global and domestic economy?
Nothing surprising, but a lot more patience is needed on our behalf, as it's going to take another 3 to 4 years before hitting bottom. It's going to take a while for the government sector to hand off its stimulus to the private sector, and then probably another 5 or 6 years to get any kind of serious economic rebound. So 2013 is probably the bottom, and 2019 before we see anything that's sustainable that can last more than just a few months or a couple of years.
That's much slower than what we hear about from everyone else that has a microphone in front of them or a press pass in front of them.
Well, you have to understand that who you're listening to and what their biases are. I mean, the government wants us to believe everything's going to be better so that we'll start to spend money and it'll be a self-fulfilling prophecy. You also have to understand people's biases, and you want to be listening to somebody that can be objective and has no bias on the upside, as many people in many industries do.
With the larger organizations repaying their TARP money, what can some of our viewers that work with these organizations expect to see in the next 6 to 12 months?
I think credit will be available to people who basically don't need it, but the availability of credit to those consumers and businesses that are struggling will be difficult. The problem isn't so much supply of credit, it's that if you want to borrow money today, you need a reason to take the risk other than if you're in trouble and you want to stay alive. But risk-taking in this country has not anywhere close to what it would take for us to have a serious, sustainable economic rebound. So we're just muttering through. We'll have periods which appear to be good. We'll have periods where we'll appear to have setbacks. But the problem with most businesses is they see the world as they need it to be, not as it is. So if you made money in real estate in the 1990s, your brain tells you that's what you're good at, and you start looking for opportunities that repeat or look the same as they are in the 90s. And history does repeat itself, but unfortunately not when we need it to.
To be more specific, what do you expect for the balance of the year?
We will see some economic growth. We'll see patterns where it will appear that lending and credit has stopped contracting. But again, we have a bad tendency, just because of nature, that we look for something that isn't necessarily there. I mean, if it's been cloudy for 2 weeks in a row, we're always looking for the first ray of sunshine. As soon as we see it, we project it out that tomorrow's going to be a clear day. This is going to be the kind of year where you have to manage your expectations and not assume that if one thing happens that it will lead to another.
Does the stock market's up right now from where it was last year? Is that any kind of indicator?
We often use the stock market as an indicator of consumer sentiment, and most people think if the stock market goes up that it will lead to an economic rebound. I'm not sure that necessarily is always the case. Frequently you see the stock market tell us one thing and then consumer confidence levels come out and show us another. The stock market just tells us there's a lot of liquidity in the system. The Fed has printed a lot of money. Sure. Most of it has gone back to the Fed for safekeeping. Some of it has seeped into the stock market. And with the dollar's depreciation in 2009, some foreign investors see the U.S. as a cheap way to buy into businesses.
Jay, let me ask you a question. What are the specific signs of stability that we would see out there that the government wants us to see and that the FDIC may sort of influence our thinking with?
Well, that's two parts. The first part is the economy can't grow until businesses decide that they want to take risk of expansion, risk of capital improvements, risk of starting a new venture. They usually can do that by borrowing, or they can also do that using savings. We're not seeing any of that. Credit continues to contract every week. The Federal Reserve produces a report called the H8 report, which comes out every Friday afternoon, and every week we see less credit and more funds from the banks going back to the Fed for safekeeping. The FDIC is only a player in the sense that they also, what they say is sometimes followed. The FDIC put out a release begging consumers to, or actually encouraging consumers to save. If you save, you have more for a rainy day, but it also means that there's less consumer spending. You can't spend more if you're saving more, unless you have the ability to borrow, and most people today, consumers, don't have that ability. So I think we need risk-taking by businesses. The government would love to see that, but at the same time, they don't want businesses to take the kind of risk that caused the debacle over the last couple of years. It's just time. Unfortunately, Americans don't have a lot of patience, and they desperately need it. This is so similar to 1872 to 1879, where most people weren't around that I know of that are still alive today. And it was a period where everyone was frustrated and couldn't wait for the economy to bounce back. And the one thing that everyone needs, no one has in this country. We're used to borrowing. We're used to consuming now and paying for it later. Consumers right now continue to pay down their credit cards and not pay their mortgages because they don't have to pay their mortgages. The government has told them, don't worry about it, we'll renegotiate it. And people don't really care. They'll walk away from their house. They won't pay for 6 or 8 months. But if you don't pay for your credit card every month, then you've got no ability to spend. So we've got a very unusual situation. And until that levels out, and it's time, the best way to think of it is you've got logs that are wet, and you want to start a fire. It's cold outside. You keep throwing matches onto the logs, and they're too wet to spark a fire. What causes the logs to dry out? Time. Just time until they dry out. 1 or 2 matches spark a fire, and then it happens. But that's going to take years.
With the shift away from excess spending, for example, RVs, second homes, vacations, toys, how is that going to affect the economic recovery? We're a consumer-driven economy.
We have to hit bottom first. You can't get a recovery till you hit bottom. We're not going to see a V. We're going to see more of an L and then just sit there. Confidence. You don't spend money if you're worried that you may lose your job. You don't spend money if you have a lot of debt that you're trying to pay down. You only spend money if you're confident that either your income's going to increase, or you've got the ability to borrow, or when an asset that you own is about to rise in value and you think you may be able to sell it. We lack that confidence right now. We don't have a system that is paying you to take the risk. It's actually giving you concern that you may be in this situation, it may get worse. And only time, who profits from time? Not many people. But Americans will slowly learn a very painful lesson that you really sort of do have to live within your means.
Jay, for some of our viewers that are considering investments on the M&A side, what are some of the things that they should consider, and what mistakes should they avoid?
I think one of the things that I think separates those that are successful business people from those that aren't successful investors is a theory that I have that people would rather lose in company than win alone. Business people really are okay taking risks because they only see the future from their past. And if you are a risk taker and you've successfully maneuvered through the hurdles that it takes and succeeded, you don't need everyone to agree with you. And one of the problems with people losing so much of their wealth over the last few years is that the people that they listened to couldn't be objective. Real estate agents, residential real estate agents, always thought the homes were a good buy. But why? Well, gee, Jay, if I didn't tell somebody that it was a good time to buy, then I might lose the purchase to another agent, so I sort of had to do it so I could keep eating. The consumer has to see through that, and they don't. So many people said to me, well, gee, Jay, if I had known that the real estate market was going to crash, I would have sold. Well, how would you know? How many people would it take to tell you that it was going to crash before you'd make the decision? Probably a lot. Very few people have the courage to act on something that everyone else tells them isn't going to happen. It takes foresight, it takes experience, and it takes practice. You can't play in the arena if you haven't lost many times, because then you know how to judge whether you have a chance to win or lose. So the successful investors over the next few years will be going against the grain and not be afraid to go against the majority, knowing that if 98% of people think that the world is going to be one way and 2% the other, it doesn't mean the 98% are going to be wrong. They're going to be right a lot. But if you're on that 2%, when you do win, it'll make up for all the losses.
Any advice for our viewers, primarily lenders, workout folks, and investors in business?
I think the biggest surprise over the next couple of years is that interest rates will not rise. Inflation is something that should not be feared. Inflation is created by the printing of money, and then, importantly, something we call velocity. If the Fed prints money, gives it to the banks, and the banks take it and put it back in the Fed's vault, as 99.8% of money that's been printed in the last year and a half is done, there's not going to be an inflation. In 1991, when Japan was at the beginning of a recession, they were increasing their money supply by over 90%. And a very famous economist named Milton Friedman, who's now passed away, told the world Japan's going to have double-digit, maybe triple-digit inflation. Japan should have been so lucky. They haven't had inflation in 20 years. It's because velocity decreased. It's called pushing on a string, a phrase that was created in the early 70s. And what people are confusing is that printing money is not inflationary if it's not spent, if it's not lent, if it's not used. And the Fed's dilemma right now is, how do we get banks to lend? How do we get consumers to spend? Because we're printing the money, no one's using it. So the surprises over the next 12 to 24 months are no inflation, interest rates stay low. Everyone is betting that interest rates are going to go higher. They did the same thing in Japan in the mid-90s, and they got slaughtered. There was blood all over the streets. Some of the biggest hedge funds in the world lost hundreds of millions of dollars. If you're going to read the newspaper, and I read 27 of them a day, if you're going to read the newspaper, don't assume that what you're reading is right. Read it to judge where everyone's making their bets. And the biggest amount of money is always made when you go against the grain. Doesn't mean you're going to be right, and you've got the most facts behind you. And there's really no facts behind an increase in inflation right now.
And we're hearing that from some of our clients and the viewers that are watching this taping now, that the focus in the marketplace and where the money is going is on the healthy credits only. So there's an undersupply of healthy credits out there, and there's an oversupply of cash to lend against that only. But the credits that are tough are...
Well, for a lender, you've got to price your risk correctly. Mm-hmm. And a lot of the lesser credits right now, I think, are not priced correctly. I think that they're actually, the spreads are too tight. The government, the federal government coming in and flooding the market with money, unfortunately narrowed some of the credit spreads. And I think that the good credits are priced correctly, but the bad credits are not. And I think some of these lenders are going to get hurt over the next couple of years as they find out they've mispriced the risk that they assumed that they had.
Jay, thanks very much for joining us. It's always great to see you, and we appreciate your input. For more information on Jay Goldinger and his daily update service, you can visit his website at earlywarningwire.com. All proceeds benefit Food on Foot, a charity dedicated to rehabilitating homeless people. That website is foodonfoot.org.
And for more information on Great American Group, you can visit us at greatamerican.com. Thank you for joining us.